Good morning, everybody. Welcome back to the Schwab YouTube coaching channel. It's our Monday edition of Trader Talk in today's market. I'm your host, Kevin Horner. I am joining you from a sunny and beautiful Denver, Colorado. Now, normally today, I would have been joined by my friend Scott Durfee. Unfortunately, Scott is a bit under the weather this morning, so I will be going solo with all of you, but not to worry. We have plenty to get to today. I am joined by Mike Fairborn here in the chat, everyone. Make sure you say hi to Mike. He'll reply to comments, questions that I'm unable to get to during today's discussion, but you can rest assured I'm going to keep an eye on all those comments and thoughts and try to bring those discussion topics into our conversation today. So please do feel free to post in there during the show. We'll go about 45 minutes in total with you all today. If you're not already doing so, don't forget you can follow Mike and me on X. We're available there. Mike Fairborn CS and Kevin Horner CS. It's a great way to follow us outside of the classes that we host for you here. It's another good way to chat with us as well. So if you reply to any of our posts, for example, you're almost assured to get a reply from us. We do want to hear from you. We love engaging with all of you. So please consider following us there on X. All right, let's get to our disclosure so that we can get into the meat and potatoes of today's conversation. Plenty to get to as always. So please remember that our conversation here is fully informational and educational. We do not make recommendations. We do not make endorsements for any specific approach to trading the market. We will, however, discuss technical analysis in this class, and in so doing, we will remind you that technical analysis is merely a piece of the decision-making puzzle. We discourage you from basing your decisions exclusively off technical analysis, of course, but ultimately, when we're making decisions, we want to be doing so from a multitude of factors. We want to consider many different concepts and strategies, of course, but when it's time to make a decision to buy or to sell, hopefully we're incorporating multiple ideas, not just one single idea. In terms of our agenda, it's a lot of the same stuff, everyone. We will, of course, be going through our top-down review of the market. So we'll start broadly with our major indices. We will work our way through those into some industries, sectors, sub-industry groups where we can, but plenty to hit on today. So let's get us started with the S&P 500, which had one of those interesting finishes to the week. You can see, everyone, that I've got this range kind of drawn in. If I eliminate the top line up here, we're going to see that we had that an attempted breakout on Friday. We traded up to a new all-time high, 65.35, 65.32 at our intraday high on Friday. And yet we saw a little bit of selling into the close. But that selling hasn't really come out in the form of reversal of price action, has it? I mean, we've seen a sideways move, essentially. Yes, we've made slightly higher highs, divergent with our RSI down below, and yet we've not seen a reversal of pattern or a reversal of trend. And so I think for a lot of traders, especially in the short to intermediate time frames, the concept of sticking with the trend continues to hold at this current point. Now, we'll see if that maintains. You do have plenty of things to be watching this week. We will have CPI and PPI this week, so a couple of measures by which the Fed might need some action. Of course, we're waiting the possibility of a Fed decision next week. That'll be a week from Wednesday, of course, the policy decision that is. But all of these PPI, CPI details will give the Fed more data, and the Fed has stated they wish to be data dependent in making these determinations. So we'll continue to monitor things on the S&P, but I think if you're a frequent attendee to this class in particular, what you know is we're going to continue to say a lot of the same stuff. The trend has held, the trend remains up, and for a lot of traders, it's merely managing positions along the way to ensure that they're working with the trend as long as the trend maintains. For now in the S&P 500, for a lot of traders, that's that 50-day moving average in purple or blue, the deeper blue here, I suppose. And you'll notice, the low that we hit last week on the open of Tuesday, which was following our long weekend, of course. We had a weak open that got bought up, and we finished the week in theory, relatively strong, right? I mean, starting weak and finishing in positive is not a negative view, of course, and yet we've really not seen a lot of momentum moves to the upside in the most recent few weeks to a couple of months here. It's just been a little bit more of a grind. So as always, the process for us traders is just to admit our own comfort and our own comfort with the amount of money that we have deployed to our trades at any given moment, and then just work with the trend as long as we can. For now, that's the 50-day for a lot of traders. For some of you, it might be that orange 20-day, but know which one matters to you, know which one you're going to work with to manage your own trade, your own trend viewpoint here as it relates to the SPX. Now, we're going to see, but when we move into the NASDAQ 100 here, the NDX, we're about 0.5% here. The difference is that we actually broke the 50-day on the open last week. Let me remove some of these deeper levels that we could have as considerations for the NASDAQ 100. I say considerations for areas of import, right? Areas where things could look a little bit different as it relates to the NASDAQ 100. Well, let's zoom back in here. We'll make note of the fact that we still have that declining RSI, right? So we can clearly see that. Even though we've made this attempt on matching highs or new highs, we've also not had a whole lot of leadership from the RSI here. So our selling has been more heavy in the post sessions, or I should say in the latter portions of the day. So, this is not exactly a bullish look in terms of momentum, just in terms of price action, right? Because we do continue to see the maintain of this more or less this range here now. And I think that range kind of stands out for a lot of traders. So we'll just continue to monitor the same. If we made a move through those recent highs at around 24,000 on the NDX, that would be fantastic for the NASDAQ bullish trader, right? Of course, a move under the 23,000 level here, 22,009.5 or so, that low we had with Tuesday of last week's open, that could be significant. And again, I want to remind you, if you're relatively new to the concept of trading the trend and sticking with things as long as they last, well, just remember, when we trade below, if we were to take the NASDAQ 100 under the 23,000 level, let's say we traded through the white line here and traded through it with any conviction to the downside, right? This ledge right here where the arrow resides. If we do that, I can't tell you that we know as traders that we're going lower, but I can say that if that happened, if we traded through that low, that our odds to go lower then increase dramatically. And that's the real takeaway as it relates to technical analysis, everyone. So let's try and remind ourselves that technical analysis doesn't really doesn't predict the future for us, but it helps us to understand where we can manage our own risk. So if you were a trader in the NASDAQ 100 specifically, and you saw the indice break 23,000 to the downside, many traders would then use that weakness as a means of tightening the purse strings, pulling money out of their NASDAQ positions, not because they're confident that it has to go down, but now they are less confident in its ability to maintain the level it's at and to thus continue to the upside. And so traders, when we start to break down, they get a little more defensive, they tighten those purse strings, they build more cash. That's ultimately what a trader might consider here. Doesn't mean that it has to. We see it all the time. We had this snapback move here where we opened at a pretty healthy, good low after a really nice move to the upside. And we had this bearish engulfing candle right here that led to a good pullback. And you would have been forgiven if you would have just said, yeah, I don't like that move. I'm going to lighten up my position. We're below the 20-day for a day, the first time all the way since back here in April when this occurred. And if you went ahead and lightened a position there, nobody would fault a trader for making that decision, for being more comfortable by eliminating some of that risk, right? It doesn't mean that they shouldn't have gotten right back in when we recaptured those levels, but I bring it up because we have to acknowledge that when we are managing our trades, right, if we fall through an area that we deem to be support and we sell because we got that action, well, you were just following your plan. And that's what we want to do. Give ourselves the plan, follow that plan. Or as we often say, plan your trade and then trade the plan. Okay, make it easy on yourself. Don't kick yourself for making decisions that give you more comfort in the moment. Okay, try and plan these things out. Have a good idea as to how you want to address them when they occur. That's ultimately what we're trying to do as traders. So the NASDAQ continues to hold up, still kind of rangy. What we're ultimately looking for are moves through the two white lines here, right? Oh, I'm going to do that with an arrow once more for you. So either of these white lines, violation to the upside, bullish, violation to the downside, potentially short-term bearish, we'll have to look for something different outside of the range we've been in here for about the last 2 months in the NASDAQ. All right, now let's see how we're moving in the Russell 2000, one of our interest rate sensitive vehicles. The Russell and small caps have continued a little bit higher here. We did have a doji day on Friday, so we had an open and a close that were essentially on top of each other. We opened at 23.90 nearly, and we closed at 23.91. So slight green on the day, and we're trying to get a little bit of a continuation day today. But we did have a lot of range in Friday's action. So today is most likely, certainly not a guarantee, but most likely to be an inside day, a day that the trade activity for it today likely resides fully within yesterday's or Friday's price action. Again, if we traded outside of those levels, that would be a bit of a heads up for us. But in the meantime, not a whole lot of a heads up here, right? Ultimately, the trend here would change under the 20-day or the 23.15 level, which was previous horizontal resistance, and now we hope is horizontal support. The fact that we tested it here last week, moved higher, made a short-term high, can give bulls a little bit of confidence that that orange 20-day and the confluence of that horizontal support could come into play. But if nothing else, that might give short-term small cap traders, everyone, the opportunity to consider maybe raising or elevating your stop exit strategies, right? You could incorporate the 20-day if you prefer. You could incorporate the horizontal ledge of support. Some traders would incorporate potentially an average true range, among other things. So you all know how this goes. It's a process of allowing your group to make new highs, and then where you can, mitigating your risk by elevating your exit strategies along the way. Ultimately, we're just trying to manage those trades and capitalize along the process of making new highs and trying to elevate those exits. So hopefully that's what we're considering on something like this. And again, you know, the Russell has been rallying on the belief that yields will be coming down. Yields have been falling. So this is playing into that same story, at least in advance of an actual rate discussion. So there has not been a policy shift, as we know. We're awaiting said policy shift, and yet the market is forecasting or ahead of the game, so to speak, right? We see yields falling. So we are seeing essentially the anticipation of this decision, right? Now, I have to bring you back to the last time we got cuts, which was back in the fall of last year. And when we got those cuts last year, if you take a look at what we'd been doing into those cuts, we'd been seeing yields drop aggressively. Well, as soon as those cuts got called in and actually noted and actually let you know policy shifts, that's when the yields started to rally. Okay, so just be aware that an actual decision does not mean that yields have to go lower. Okay, so keep that in mind. This could very well play out as a buy the rumors, sell the news type scenario. It would not shock a lot of traders that that's the case. But nonetheless, we are getting some lift to small caps there over the last, say, week and a half or so, tied directly almost to the yields falling. Now, if we continue to get some of that, so that R word, that recession word, into the narrative, then small caps could have a little bit of a struggle here. We're going to have to keep an eye on that, right? If the story becomes recession, small caps are less likely to produce. Okay, so we just have to be aware of that. All right, how about one of our most important industry groups, not a sector itself, but an industry rather, semiconductors. Now, the semis holding up here. Okay. Yes, we had that week below the 50-day moving average, but ultimately, if I were to zoom in here, again, we could say that we've really just gone sideways since, late June here, actually, early July, right? So we've really just done this maneuver. And that's telling us that the momentum has left the semiconductors, of course, but that's not necessarily terrible because we've just consolidated in this move, haven't we? After a wonderful big move off the lows. In fact, if we drew the trough to peak move up 74%, everyone, look at that, 74% in 90 bars, 89 bars total, right? So that is a pretty good move. 90, of course, would be what? Let's see, I can do the math. 18 weeks, so that's not too bad, I suppose. Pretty strong, right? About 4.5 months to make a 74% move. Therefore, as Grant is calling it out, consolidation, absolutely true. Ultimately, that's all we've done here, consolidate. So what happens with consolidation? Well, this is a great question, but ultimately, traders believe that if you consolidate long enough, then you have every reason to think that we can take the recent directional move from the low to the peak. If we consolidate, if we break to the upside, now we can believe that there is more upside on the table for the semis. The fact that we've just gone sideways like this and have largely held the majority of this move should be a bullish validation. Now, you can't be validated without really new highs, right? You can't be validating the movement in the semis without trading through and making new short-term highs. But nonetheless, this has held up quite well as we've gone sideways, basically. And we've seen some of these other, the broader groups have actually shown more weakness than the semiconductors, right? So semis have held up quite well. If we, for example, just looked at the tech space by itself as a sector, you'll see here we are in the process of validating the low we just made last week yet again. Look at that, right on the 50-day with the tech. And again, we've got this kind of a down slope off the peak. Some traders would tell you we're in the midst of breaking it right now. And some would say maybe failing at it. It's way too early to know if that's a fail or a break just yet, right? But ultimately, that's what we're looking for. Can we make a short-term high? I think a lot of traders would say you got to trade through the high we made here on the 28th. That would be at about 53.37 or so. That could give you an area potentially to believe that we are making our way back to prior highs in the info tech group. But so, technology broadly holding up quite well. Semiconductors still in consolidation mode, but holding major moving averages. So we've seen a lot of consistency there. Amongst the other groups that are moving today, we have communications moving favorably, continuing a breakout. Goodness, if you were looking for a method to manage your communications trades, everyone, I think that 20-day moving average stands out quite a bit, doesn't it? This is where those the knowledge of what you consider to be a valid test of support. Is it a 1-day scenario? Can you test it for 2 days? Do you need 3 days? What is it that you use to validate confirmation? For some traders, these single days beneath the 20-day weren't sell opportunities, but rather buying opportunities, because you've come down to the 20-day and each of those 20 days have been gobbled up rather quickly, right? Buyers step right back in and are more than happy to join the uptrend in communications. And then last week, it wasn't just holding the 20-day. Last week, we broke through the resistance there for just about 2 weeks, and then just saw that continuation move to the upside. So that new trend working against the 20-day really strongly here. Now, this could shift today. We're going to get to some stocks in the news, and definitely, and because you're absolutely right, BJ, Google or Alphabet and Meta have been participants in that move in communication space, leadership in that communications group, but there have been some recent headlines that I'm going to make note of that are very important for us. So I'll bring those up momentarily. One of the other spaces within, as an industry group within technology that I thought we should look at is software here real quick. So let's take just a quick peek at software because it does stand out a little bit, right? And I think it's a really good reminder that when we are thinking about trading a sector, that there will be leaders within that sector. There will be industries and sub-industries that could be the leadership groups. You've seen us discuss this as it relates to healthcare. Here in technology, notice the discrepancy. Semiconductors holding up, stocks looking better in consolidation, right? Technology as a sector looking stronger, almost set to break out. Here you have the entirety of the software group under a 20-day moving average now, dating back to about August 13. So that puts us at about a 4-week window, 3.5 to 4 weeks. And we've also been consolidating below the 50-day moving average. And if we were going to try and put a visual on this, it could look a little bear flaggish. Now, we don't need to be taking bearish positions or anything like that necessarily, but I wanted to bring it up because it does stand out that not everything in technology is moving so wonderfully, okay? And we have some software stocks, again, that we need to be aware of. We're going to be hearing from Oracle later this week. I think they report after the bell tomorrow, the 9th, if I'm not mistaken. So there's an opportunity for this group to continue to maybe fix things. It's unclear whether we've got a trend shift or just a support test. A lot of traders could validate a support test in here, couldn't you? I mean, the space has pulled back to what once was an area of resistance, right? Brief resistance, albeit it was only there for a week, but we broke out, trended higher for a few weeks, pulled back, found horizontal support. I would venture a guess, because I love drawing these Fibonacci levels. I would think, everybody, if I drew a Fibonacci from the trough in April to the peak that we just made in July here on the software, I'd bet that this white line comes in around the 23% level. Let's see if I'm guessing or if I know what I'm talking about here. I'm just going to start right here, draw it to right about here. All right, and so, yeah, it's in the vicinity, isn't it? It's close. So we could certainly say that a pullback to this area is perfectly within reason and makes sense for the trend trader. In fact, let me just remind you of the concept as it relates to the Fibonacci sequencing. With the Fibonacci move, when you find that you have a beginning point and an end point, what we're looking for is a proper pullback, which can happen at any of these first 3 areas. It can be the, I'm going to fix this here real quick. Let me just... There we go. So you've got one here, one here. Whoops, I should have done that. I should have flipped that. And then we're going to cheat. I'm going to duplicate it. All right. So any of these first 3 levels, essentially, okay? The 23% retracement, the 38%, or the 50%. All it states is that you can make a move up or down and give back 23% or 38% or even 50% of that move and still maintain the trend opportunity that we came into it with. So this being an uptrend, theoretically, we could pull back to the 23% and continue the uptrend from there. We could pull back to the 38% and still continue the uptrend. We could even pull back 50% and still continue the uptrend. That's what the Fibonacci sequencing might tell traders here. So this is a good area for short-term support. Remains to be seen whether we will be holding this level, but it does give traders, if nothing else, an area under which they might say, okay, if we made new short-term lows in here, well, then now I need to be prepared for a bigger move to the downside, right? The odds of a bigger move or a deeper pullback increase if we trade through the lows we've made in the last couple of weeks here, all right? I don't know if that's going to happen. I don't know if this line's going to be held, but I do know that if we traded under that white line, our odds to go lower have increased, and that might give traders in software reasons to be a little more defensive, okay? So there's one consideration as it relates to software, which does look different than the semis, which do look different than the technology as a sector here. Okay. All right. Let's see. We do have a whole lot of stocks in the news today. I was just talking software, so let's go ahead and pull up Oracle. Like I said, we do have an announcement on Oracle this week. They are announcing after the bell tomorrow, the 9th. Now, today, in advance of this, we had some updates to their price target. So let me share these with you. JP Morgan raised the price target on Oracle to 210, up from 185. It maintains a neutral rating ahead of their Q1 report. JP Morgan seeing momentum across the technology industry, AI infrastructure bookings. That's their reasoning. Morgan Stanley raised the price target on Oracle to 249, up from 175, maintaining an equal weight rating on the shares. Says some revisions could be coming towards based on the upcoming Analyst Day. Barclays also raised the target on Oracle to 281 from 221. They also maintain an overweight rating on the shares. They state that Q1 is normally a small seasonal quarter that doesn't matter. This year will be different as the focus will be on their $30 billion annual recurring revenue deal that was announced in June. Okay, so that gives you some topical details maybe to listen in for on tomorrow's report. While I've given you 3 separate price targets from 3 big analyst firms, reminder, price targets are no guarantee to be achieved, particularly analyst targets, not to mention, of course, those measured move targets that we traders might incorporate, but nonetheless, no guarantee to be achieved in any way there as it relates to Oracle. Now, the Oracle chart is a little intriguing because we do have a pullback to what some traders would say would be horizontal support, right? Breaking through this ledge here, which was a beautiful bull flag, and then we rallied aggressively, made a nice 20% pop on that, and have then pulled back. Now today you're getting that lift into that confluence of the 20 and 50-day moving average, but I know it's tough to be a trader taking a new position in a stock that's due to go to earnings tomorrow afternoon. So I can understand being timid as it related to the price action here in Oracle. For those of you in Oracle, let's just briefly take a peek at expectations tied to the option viewpoint here. I just wanted to highlight the expectation. So the implied volatility is elevated, and just based on this, we can suggest that the implied volatility tells us that the expected market move after earnings would be about $22 on the position. So that's not small by any stretch. You know, we're trading at 237, so we'd be looking at about a let's see here, about a 9.25% potential move. But again, that's merely telling us we have elevated implied volatility. We don't know directionally how that could go. We just know that the way that implied volatility is viewed, it's letting us know there's a possibility for as much as a possible 9% move on the earnings basis. All right. So there you go. And yeah, Beth, why not? What's going on here? You said take a look at Max and monthly. You know, not a terrible look as it relates to Oracle in the longer haul, is it? We could add a little bit of time to this. I've only got 3 years. Let's go ahead and make it 10. You know, look, if you're looking for charts that go from the lower left to the upper right, this is certainly a validated bullish chart. I think the thing that Beth might be speaking to here is that break above this level. And then the hold of this level. Notice that green upslope. That green line is the 20-week simple moving average, everyone. So that's allowing the speedier, on a longer term basis, the speedier moving average to get caught up in here. The other thing that stands out to me that's a little bit head scratchy is the volume at this elevated level. So the question becomes, is all of this volume stemming from traders piling into Oracle here, or is it stemming from traders trying to unload larger Oracle positions and needing as much participation to unload those positions as possible? That's a fair question, because when you go back to, say, the summer of 2020 or the fall of 2022, if we just drew a line to validate the prices or the amount of price movement, basically we're looking at a 3-year move of about 330%. So that doesn't mean that institutional traders are moving out of it, but it could mean that, okay? And that's something that stands out when I see volume at upper ranges. Okay, the stock has been at an elevated price level. We want continuation from the trend, but there's been clearly a lot of volume in this, okay? And so my question is, without an answer, I don't have an answer. My question is this volume adding to Oracle, buying at these elevated prices and giving us a chance for yet another leg higher, or is this more potentially not consolidation, but rather a distribution phase where we're getting a lot of volume because these big, deep pocket investors who've been owning Oracle for 3+ years are in the process of unloading Oracle finally? That remains to be seen. But that's a thought that you got to at least keep in your mind, because a breakdown here in what we've had of late, if we don't make that move higher with this action, because it does look favorable right now, right? At least on the weekly, we could call that a break on the weekly chart. Remains to be seen. It's a little early, but if that candle was not going to turn green and started filling down to the red side and taking us lower, and suddenly we're under the green moving average, things would change quite a bit. So it's unclear, as is often the case. Let's just keep it in mind. All right. More stocks in the news. How about a price target change on Apple today? And let's bring that up. So Apple at Jefferies had their target raised to just shy of 206 from 190. They maintain a hold rating on the shares. Fiscal Q4, quote, could be a miss, end quote. But the firm's fiscal 26 and fiscal 27 estimates are similar to the consensus. Tariff relief, antitrust remedies, and AI-driven Siri service reports have driven the stock up 18% these past few months. The firm now believes that this good news is built into the price, and they note that the fundamental concerns, so to speak, are unchanged. So again, 206, the new level for Apple. The price chart here, however, tells us something that we need to pay attention to. We did have a nice gap. So a couple of things we can consider on Apple, depending on your current positioning, of course. If you've been long, some of these traders might look for an exit strategy that would take you, under the gap level that we made last week. So some would look at the lengthy tail there, and maybe that's what they're going to work with. Some traders might use the 20-day moving average instead, and some still might use the 20-day average less the average true range, which is also a consideration, right? So maybe you're looking at the 20-day, which comes in at 231.65 today. All right, so 231.65 minus that $4.23 as an example of a price level under which the traders might look for an exit strategy. That's one way to give them maybe a little bit more comfortable of an exit. A reminder: you can be a seller in any manner you prefer. You can be a seller on strength. You can be a seller on weakness. It's entirely at our discretion as traders. And I just want you to all be thoughtful about what it is that gives you the comfort to be a seller one way or the other. But, Apple has been, at least for the last 4 days here, this was a really nice move out of this flattening, this channel of consolidation that basically was 225 up to 235. So we had a nice little $10 consolidation like that. That's played out pretty well thus far. We'll see if that matters more than the break of, say, the downtrend, which does stand out to me, because when I see this, the one thing I note is that since that broken downtrend, it's only been bullish, right? So you had a beautiful nice little flagpole with a 2 to 3 week flag, cloth flag portion that just got broken last week. So 235, $10 potential range of that consolidation. We'll just flip that over, right? So 235 could potentially go to 245 for at least a measured move calculation, which once more are never guarantees to be achieved. Happens to coincide a little bit with those prior highs that I found back here. So maybe that's, between 245 and 248 for some traders. But we'll see how that plays out. This obviously could be a week where we either get continuation into that resistance, or maybe we get weakness to the 20-day. We'll see. One of those is going to happen. One of them is going to happen. We'll see which one which one of those plays out that way. All right. How about some upgrades or downgrades? I mentioned when we were looking at communications, everyone, we did have some changes there. We got to look at Alphabet, because Alphabet did get downgraded. Now they've been on a tear. So there's, and obviously, if you're an analyst and you downgrade a company and they continue to push upward in the face of your downgrade, that never makes you feel too good. But I have a feeling that some of this conversation around Alphabet is going to be based on the movement we've seen. Stock has made an unbelievable move from the April trough. 70% nearly over the last 106 sessions. That's a fantastic move, of course. The news here, like I said, Alphabet downgraded at Phillips Securities to accumulate from buy with a new price target at 265. That is up from 235. The firm views the district judge ruling positively, believes that restrictions on exclusivity will have limited impacts on Google's product strength and partner incentives. However, they cite valuation for the downgrade following the stock's recent rally, as I was suspecting. So, yes, the stock has been on a tear. Yes, the stock is at highs. Really difficult to call this anything other than a bullish chart. Let's take a look at this on a weekly real briefly, just to make sure that we're seeing the forest for the trees. And my goodness, everyone, what did we have? We've had a breakout and a throwback. So we had this long-range throwback to support, rallied, made a new high. Same thing. Duplicate that oval, got thrown back to support. In fact, we made a lower candle move there with that April low. But again, that was a little different. That wasn't a sell-off on Alphabet. That was a sell-off on uncertainty, a sell-off on tariffs and the so-called tariff tantrum. And ultimately, we've moved out of this range, 150 to call it, let's just make it simple, 150 to 200, right? So could this be a 50-point range upside, majority of which has seemingly already been achieved if we're looking for a 50-point range breakout from the 205 level. And so, yeah, you've got maybe some more upside based on that measured move, but I'll once more have to remind you that's no guarantee to be achieved. But I do find that that pattern of up and pull back, breakout and pull back, or breakout and breathe, that's kind of what you're looking for. But it's to this point doing a favor, doing a kind of a spitting in the face of the analyst, at least on the intraday basis, the first opening basis here today. So if you're in the position, again, remember what gaps can imply for you. Some traders are going to look to hold the gap ledge. As long as the gap level maintains, they'll stick with the position. Not every trader out there is going to be comfortable allowing the stock to drop $14 to $15 before they decide what to do with it, right? So just know what it is that you want to make your decisions on. Do you like to take profits at these elevated levels? Do you prefer to only sell when the trend breaks? A close under that 224 would look a little ugly for the traders that have been participating in this breakout. So just make sure you've got some levels where you would choose to make some alternate decisions. All right, how about an upgrade, everyone? Let's take a look. One that definitely falls into my Horner household here is Chewy, tied to my pooches. So I've got a breakout here in price, at least started hot today. So this is a little notable. The action looked really intriguing on Friday with this beautiful candle, this green candle right there that was through all of those recent highs, right? A lot of traders would say this looks kind of like a bull flag itself. And then today we've got this red candle where we started favorably, but we opened at resistance and have since faded. Now, let's not go too far. We're not going to get too concerned about a stock that opens at resistance and breathes in the first hour of trading. But let me give you the headline here. Mizuho analysts upgrading Chewy to outperform. Previously, they'd been at neutral on the stock. The target is at $50 a share. That's up from $44 a share. So a nice little lift there. They state that the stock's risk reward is tilted heavily upward at this time, following that recent pullback. The firm expects Chewy's earnings report on Wednesday, and they've updated the fiscal 2025 outlook to be strong and provide a positive share catalyst. So, taking all that into account, positivity, they like the opportunity in the near term and the potential for that $50 target. You know, some traders would be patient and see how the price action handles. The today's move is handled really, because again, that is a wonderful open that has since faded. Let's see how this looks on a 5-minute bar. All right, so we're back. Okay, so this is standing out. I'm going to eliminate that oval here. So we had that really optimistic open, and we couldn't even hold the pivot. We tried to, you could see that bulls tried to mount their stand at the pivot here, right? We've got a lot of back and forth right here, but it just could not hold. So we sold it down a little further. So the momentum selling in here is not ideal if you were looking for reasons to be uber bullish on the heels of the upgrade and the chart's price action. The chart price action being that we traded outside of this flag. Now, that for some of you, that could still be okay. Today's action could just be a little bit of profit taking after such a decent move. And I do mean decent. I mean, if we just check this out, that's 28% in about 5 weeks. So absolutely intriguing. But if you are going to take the positive view here, ignoring the depth of that red candle, the level that might matter most is the one we made with the low on Friday. So let's maybe put a line there and give you something on the intraday charts to monitor. If you can hold the gap level, then some traders are going to say the only thing that matters here is the fact that we are outside of this, all of this action right here, right? The fact that we've got these 2 days, as long as this low that we made on Friday is held, this becomes a very important level for the bulls to hold. And if not, maybe then things get a little messy and we just need a more time as it relates to that 20-day moving average. Maybe we need that to get caught up. But ultimately, watch that gap ledge. Those gaps can be very instructive for us as traders. And yes, of course, Paul, thank you. Earnings have to be notable. Earnings are coming here on the 10th. So that'll be, that's Wednesday morning before market open. Good point. Good point. All right. And I think it's going to pretty much leave us at time today, everyone. And the reason I'm a couple of minutes early, but I wanted to remind you all, as I was looking through our calendar, we, of course, have got events coming for all of you. So I was just checking this out. I'll be in DC this weekend for the Technical Analysis and Options Workshop. That one is already filled up. Unfortunately, we don't have an opportunity to add seats. However, I wanted to let you know we do still have seats available for the Market Drive in Dallas next week, the 20th. That'll be a Saturday morning, all-day event, of course, on Saturday. Same thing in Chicago on the 4th. I'll be there for that one as well. And then more seats available for the next workshop after DC, which is in Orlando, the 10th and 11th, Friday and Saturday. So some excellent opportunities for you to come out and shake a hand and see the crew at one of these events. I'll just remind you that, the workshops, we ask you to bring your device and participate in the segment. We basically treat it like one of the concepts like we go through here on these classes. But the market drives are a little different. 1-day session only, third-party guest or Schwab Center for Financial Research speaker guests, and then lots of opportunity to see what we are thinking about as it relates to the market and what the expectation from the Schwab Center for Financial Research suggests as we head toward the end of the year. And of course, we wrap that up with a cocktail hour, so you get an opportunity to see your favorite coaches and have a drink with everyone. So with that, I'm going to go ahead and use the opportunity to wrap the conversation today, but I want to thank you all for being here. I will be in Dallas. I will be in DC. I will be in Chicago. I will be in Orlando. I have got a lot of travel on deck. I can't wait to see you all out there. Big thanks to Mike Fairborn in the chat today, and a big thanks to all of you for being here. Don't forget to follow us on X, Mike Fairborn CS, Kevin Horner, CS. If you like today's conversation, hit that thumbs up button for me below. That'll really help me out, get this out there in the YouTube algorithm. We're going to get this reviewed, of course, and into the archive as quickly as we can today. So with that, have a fantastic Monday, everybody. Plenty more to come from us, but I surely look forward to seeing you all again here real soon.